Fundamentals of Accounting Module 2, Lesson 2. Lesson 2. Debits and Credits. The Language of Accounting. What are debits and credits? In accounting, debits and credits are the foundation of every financial transaction. They are used in a double-entry accounting system, which ensures that every transaction affects at least two accounts and that the accounting equation stays in balance. Assets equals liabilities plus equity. Every time a transaction is recorded, one account is debited and another account is credited. Total debits, total credits in every journal entry. Practical tip: always ask these questions when analyzing a transaction. 1. What accounts are affected? 2. Do they increase or decrease? 3. Are they asset, liability, equity, revenue, or expense? 4. Apply the rules to decide debit or credit. In simple terms, the business debits when the business, example, acquires something of value, buys a delivery van or computers, pays for operating costs, pays rent, salaries, and utilities, sells on credit, lets customers pay later. Records, accounts receivable. The owner takes money out for personal use. Records, drawings, incurs or increases business expenses, spends on advertising, repairs, etc. In simple terms, the business credits when the business, example, incurs a liability, borrows from a bank, loan payable, earns income, renders services, service revenue, receives capital investment from the owner, owner adds funds, owner's capital, reduces an asset like cash, pays off debt using cash, reverses an expense or gets a refund, receives a refund for prepaid rent. Let's break down how accounting accounts work using a simple table and a memory trick. DEA-LER. This table helps you understand three key things for each account type. 1. What group the account belongs to. 2. Its normal balance, meaning which side it's naturally on in the accounting equation. 3. How it increases and decreases using debits and credits. Let's start with the left side of our mnemonic. DEA. D is for dividends or drawings. E is for expenses. A is for assets. These accounts have a normal balance on the debit side. That means, to increase any of these accounts, you debit them. To decrease them, you credit them. Example, if a company spends money on rent and expense, we increase the expense account by debiting it. Or if it buys equipment, an asset, we increase the asset with a debit. Now let's look at the right side. LER. L is for liabilities. E is for equity, also called capital. R is for revenue or income. These accounts have a normal balance on the credit side. That means, to increase these accounts, you credit them. To decrease them, you debit. Example, if a business takes out a loan, a liability, we increase the liability with a credit. Or when it earns money from sales, revenue, we credit the revenue account. So remember, DEA accounts, dividends, expenses, assets, increase with debits. LER accounts, liabilities, equity, revenue, increase with credits. And that's how the table works. It tells you what the normal balance is and which side, debit or credit, increases or decreases that account. Simple, structured, and super helpful for journal entries. Let's clarify each one with real-world logic. DEA equals debit accounts, normal balance, debit. 1. Dividends, drawings, O. When the owner takes money out, it reduces equity. Increase equals debit, owner takes 10,000, Dr. Drawings. O. Decrease equals credit, reversing a drawing error. 2. Expenses, O. The cost of running the business. Increase equals debit, paid rent, salaries, Dr. Rent expense. O. Decrease equals credit, refunded insurance, car, insurance expense. 3. Assets, O. Things the business owns or controls. O. Increase equals debit, bought equipment, Dr. Equipment. O. Decrease equals credit, sold inventory, SEER inventory. LE equals credit accounts, normal balance, credit. 4. Liabilities, O. What the business owes. O. Increase its credit, took a loan, notes payable. O. Decrease equals debit, paid off part of loan, Dr. Notes payable. 5. Equity / capital, owner's share in the business. O. Increase equals credit, owner invests 50,000 capital. O. Decrease equals debit, drawings reduce capital. 6. Revenue, income, O. Money earned by the business. O. Increase equals credit, service provided, service revenue. O. Decrease equals debit, returned product, Dr. Sales returns. Memory game. What gets debited? If the account represents something you own, use, or spend, like assets or expenses, you debit it. If you are taking something back from the owner, like drawings or withdrawals, you also debit it. What gets credited? If the account represents something you owe or a source of funds, like liabilities or capital contributions, you credit it. If it's something you earn, like revenue or interest income, or a decrease in your expenses or assets, it also gets credited. Example 1. Owner invests capital. Transaction. The owner invests $100,000 in cash into the business. Debit. Cash asset. $100,000. Credit. Capital. Equity. To record initial investment. Explanation. Cash increases an asset, so we debit cash. Owner's equity increases, so we credit capital. Example 2. Business purchases equipment for cash. Transaction. Buy equipment worth $50,000 in cash. Debit. Equipment asset. $50,000. Credit. Cash. Asset. $50,000. To record purchase of equipment. Explanation. Equipment increases asset debit. Cash decreases credit. Example 3. Business makes a sale on credit. Transaction. Sold goods worth $30,000 to a customer on account. Debit. Accounts receivable. Credit. Sales revenue through $30,000 to record sales on account. Explanation. You haven't received the cash yet. Accounts receivable. Debit. Sales revenue increases credit. Example 4. Pay monthly rent of $10,000. Transaction. Paid rent for the month. Debit expense. $10,000. Credit. Cash. To record rent expense. Explanation. Rent is an expense. Debit. Cash decreases credit. Example 5. Owner withdraws $5,000 for personal use. Debit drawings. $5,000. Cash. To $5,000 for drawings. Explanation. Owner's withdrawal is not an expense, but a reduction in owner's equity. Debit drawings. Final tip. Don't memorize. Understand. When analyzing any transaction, just ask, what accounts are affected? Are they increasing or decreasing? Are they assets, liabilities, equity, revenue, or expense? Then apply the DEA-LER rule and you're good to go. End of Module 2, Lesson 2.